Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is your weekly video newsletter. This week, we kind of have a lot to talk about, but it's a lot of headline stuff. So first things first, I want to talk about the Federal Reserve. So on Wednesday, they came out with their comments ending a 2-day meeting, and basically what they said is they're going to keep the Fed funds rate at where it's at now, which is 0 to 0.25% for the next 3 years, all the way into 2023. Now, those of you who've been with us for a long time, you know that the Fed funds rate is directly correlated to short-term lending, things like credit cards, car loans, lines of credit, and then the such. As far as the Fed's participation that affects the mortgage side of the world, which is your money you pay every month, that has to do with their participation in buying mortgage-backed securities. When they pump $100 million a month or $50 million a month into buying mortgage-backed securities, that's money that goes into the market that can be lent to folks like you and me. That's what's been happening for the last few months since the CARES Act came out and since they committed to help bring new money into the market. Now, they're not really bringing money into the market, they're bringing availability of credit into the market by letting banks borrow it from them cheaply to offer it to people like you and me. Now, the question is, how much longer is that going to happen? Well, they really didn't say how long it's going to happen, but there really isn't enough evidence to show them that they could just quit right now. So what we think is going to happen is, at least for the next 3 to 6 months, they'll probably continue participating at a rate equal to where they're participating now, and maybe they'll start tapering it off as we get through the election cycle, as we get into a new year, as we get some new people in office from not just the presidential spot, if that happens, but also in Congress and the House of Representatives, so or just Congress. So I'm just thinking that they're going to be pause and wait and see, because we also have other headlines that they're looking at too, which is things like the forbearance numbers and the people that took forbearance as an option or needed forbearance during a time when they didn't have any work and they were unable to make their mortgage payment. Now, on the surface, you look at the forbearance number and you go, wow, forbearances are actually going down. Well, part of that is because people are getting reemployed, getting their job back altogether, or getting some hours back, and now they're able to catch up on their mortgage or start paying their mortgage again. The other side of the coin is that you have mortgage modifications on the rise, which means that people that were in forbearance or people that were late are now having their loans modified as a solution to the financial and economic problem they were having. So it's like on the front side, it looks like forbearance numbers are going down, but then on the back side, you have mortgage modifications that are going up. So some of the forbearance declining is because of people getting jobs back and making their payments, and some of it is because economically things have not changed for people and it's still rough out there. So we're gonna have to wait and see a little bit more about what that looks like in the future, but that's something we're watching closely, because as forbearances continue and once they eventually expire, then people are gonna have a decision to make, and if they're still unemployed and they're still unable to work, then it's going to be hard for them to catch up on their payment, and those could potentially be future foreclosures, and we definitely don't want to see that. The other thing that I want to talk to you really quickly about today is just timing. And the timing in the market right now is very unique and very different, but it's something important we need to talk about really quick. If you're looking to purchase a home right now, we've been saying it for weeks already, that the timeline needs to start months before you think you need to move. And the reason is multifold. Number one, prices are staying the same because rates are keeping money cheap. So low rates equal cheaper money equals prices of homes can stay where they're at. Plus you have a lot of demand with not a lot of supply. And you have, related to that, you have a lot of people bidding on the same house you're looking to go buy right now. In some cases, we've seen as many as 20 people bidding on the same house. Just this week, we had a purchase that had 9 other bidders with our borrower, and our borrower got in. But that means for the other 9 people, they are still out there looking. So you need to start, I'd say, 60, 90, or 120 days in advance if you're looking to make a home purchase. And if you're looking to do the refinance, it's best you start now because of the uncertainty. And I really know that you don't want to hear that, and I don't even want to say it, but the uncertainty surrounding bank overlays right now is really disconcerting. And the reason is this. Not all banks are created equal, as you probably know at this point, but each bank has their own risk tolerances. So even though VA rules may say something, FHA and conventional loan rules might say, oh, we'll allow this, 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 this. Well, the banks have their own risk tolerance that they layer on top of that to determine whether they'll extend credit to you and me. That could be credit score, loan to value limit, loan size, all sorts of variety of reasons that they may just be risk averse to. And one of the things that is challenging in being in the mortgage situation on this side of the camera is that not every situation is created the same. So I can't just tell you that, oh, this is exactly how it's going to go. You know, we can make our best guess and we'll be like 80 to 90% there from day one when we talk. But there's some just circumstances that are happening with borrowers at banks that are completely out of your control, completely out of our control. And one of the things that is challenging is that sometimes we just come into the office in the morning and, oh, bang, new rule, or bang, new way we have to measure something, and it's just getting a little bit crazy. So one of the things I'm asking is that if you have a refinance to do, start early and then bear with us. I hope you have the expectation as we do that we know the majority of what's going to happen, but there always seems to be something at the end or in the middle where they just like hit us out of left field with something. We go, where'd that come from? Why do we need to go get this? And they explain it and we go, okay, fine, let's go get it. And then we have to work together side by side as, you know, client and business to make that condition get met or to satisfy the underwriter's request. And so we're just asking that if you have a refinance, just bear with us as we move through that process because we're seeing it happen more and more. And when it starts to happen on a more frequent basis, then it raises our uncertainty a little bit about how the process will go, which shouldn't make you feel any more nervous or less confident in it. It's just that there's something on the other end of the deal where underwriting or funding, they're going to be more scrutinizing, or they're going to be scrutinizing deals more right now, which is an indication of credit tightening. So even though rates are low, credit is getting a little bit tighter as we continue going more and more months away from the initial shutdown. And as the Fed continues putting money back in the market, banks are lending it, but they're also going to be a little bit less risk tolerant as we proceed because they do not want to become over leveraged by reducing standards. Last time they reduced standards, we had a huge housing crisis and a huge mortgage crisis. They don't want that again. So in order to get money out to the public, we're doing all these really low rate refinances, which is helping. But they're also doing that with kind of one eye on their risk to go, I don't know how much longer we're gonna do this. So if you are gonna be doing a refinance, just understand that these are some of the ins and the outs of what's happening behind closed doors. And when we're not on camera, we're not on the phone and email, we're dealing with these situations, trying to help you save money every month and trying to do our best job to do that on time. But sometimes that's met with resistance and challenges. So we appreciate your time of being patient, and we thank you so much for continuing to trust us. If you have any questions about any of this I said, you need to talk in more depth, or you have a specific scenario you need us to look at, please leave a comment below, or you can reach out directly to us at the office so we can help you out. Thank you so much for watching this week's video newsletter, and we'll see you again next week.